Welcome to the Opening Bell Report.
Okay, let's unpack this.
Yeah.
Because honestly, when I first pulled up the sources for today's deep dive, I thought I was looking at two completely different reports.
From like different universes, right?
Exactly. It's jarring.
Yeah.
I'm staring at the numbers on the screen, the raw data, and then I'm looking at the market reaction, and they are telling two completely opposite stories.
It does feel a bit like looking at a paradox, doesn't it? Or maybe a glitch in the matrix.
A total glitch. We're talking about IONQ's Q3 analysis. And let's just set the scene for you here. On one side, you have the stock market acting like the sky is falling. I mean, shares plummeted nearly 14% in a single day. Just a massive red candle on the chart, closing at what? $30.43.
Yeah.
If you only looked at the ticker tape, you'd assume the company just announced a massive failure.
Or that the CFO fled the country. Something dramatic.
Right, or the lab caught on fire. He has all the hallmarks of a panic sell. It screams disaster.
But then you actually take a breath and open the financial report.
And that is where it gets incredibly confusing. Because while the stock is bleeding out on the sidewalk, the business itself just posted its strongest growth quarter in history.
And not just a little bit better.
No. We are not talking about a polite little uptick here. We are talking about a triple-digit explosion in revenue. So what on earth is going on? How can a company have a record-breaking quarter, arguably a perfect quarter, and get absolutely punished for it?
That is the disconnect. That's the market paradox we need to explore today. It's a classic case of short-term market psychology clashing with long-term fundamental velocity.
So selling the news.
Exactly. The market is it's doing what traders do. They see the event, the earnings call, and they take their profits and run, regardless of the quality of the data. But our mission today is to look past that red ticker and see what the data actually says about the future of quantum computing.
And the analysis report we're looking at suggests that if you can look past that panic, if you can stomach the volatility, you might be staring at what they call a generational buying opportunity.
Big claim.
A very big claim. So are we looking at a disaster or are we looking at a discount? Let's dive into the numbers.
Let's do it. And I think we have to start with that headline growth number. Just because of the sheer magnitude of it, you really can't overstate it.
It really is the elephant in the room. The report highlights this massive statistic, 221.5%. year-over-year revenue growth. I had to double check that. 221%. That's not a typo.
It's an incredibly aggressive number, and context is everything here, In the world of, say, established blue-chip companies, you're popping champagne for 10% growth.
Right.
Even in high-growth tech, 50% is considered stellar. If a software company grows 50%, everyone calls them a unicorn.
But 221%.
That signals a fundamental phase shift. It's a change in the state of the business.
So let's put some real dollars to that percentage to ground it for you.
Yeah.
What does that actually look like for IONQ?
In Q3 2025, their revenue hit $39.9 million. Now, to appreciate why that matters, you have to look at where they came from. The old baseline, what we were used to seeing from them just a year ago, was revenue hovering in the $12 million range.
So they have basically tripled. They've effectively tripled their output in a 12-month window.
Yeah.
That is fast.
It's remarkably fast. And this is a key takeaway for anyone listening who's trying to figure out if quantum computing is still just a science project or
a real industry.
Exactly. When a quantum company is making 10 or 12 million, that can often be explained away as sandbox money.
Sandbox money. That's a good term. Break that down.
Research grants, government pilots, some experimental funding from universities. It's effectively, here's some cash, go see if this physics experiment actually works.
So it's not recurring.
It's non-recurring, it's lumpy, and it doesn't prove there's a real market. It feels like a donation almost.
Right. It's R&D subsidies disguised as revenue. It's not a business yet. It's a funded lab.
Exactly.
Right.
But when you hit 39.9 million in a single quarter, and you're growing at 221%, that tells a completely different story. That volume proves that IONQ has graduated.
Graduated from what?
From being a science experiment to enterprise production. This isn't just grant money anymore. These are commercial contracts scaling up. Real customers, corporations, huge data centers are paying real money for a product they intend to use.
To solve actual problems. That is a huge distinction. It's the difference between a university lab and a factory floor.
A prototype car in your garage versus selling cars on a lot.
Right. But I have to play devil's advocate here. Is this just a one-off? Did they just land one massive whale of a client that inflated the numbers for Q3, or is this sustainable?
That's the right question to ask. But looking at the report, this didn't just meet expectations, it crushed them. It beat the high end of IONQ's own guidance. And that is a nightmare for Wall Street analysts in the best way possible.
How so? I thought analysts liked being right.
Oh, they do. But analysts build these complex financial models trying to predict how fast a company will grow. They have spreadsheets with thousands of cells assuming a certain growth curve. When a company beats the high end of its own guidance by this margin, it breaks the model. It forces every analyst to go back to their spreadsheets and recalculate their entire projection for the next 5 years.
Because customer adoption is happening faster than they thought was possible.
Faster than the experts thought it was physically possible. The reality on the ground is moving faster than the predictions on Wall Street.
So the engine is running hotter than anyone anticipated.
Exactly. And that leads to this phrase the report used, that this 221% growth is no joke. It's a statement of validity.
Okay, so we have this incredible revenue velocity. The engine is definitely hot. But I want to pivot to something that might be even more important for a deep tech company like this. Survival.
Yes.
Because we know the history of tech stocks. We've seen plenty of companies grow fast, burn bright, run out of cash, and die.
The infamous valley of death for startups. It's littered with the skeletons of cool technology.
Right. So how safe is IONQ really? If the economy turns, or if investors get scared, like they obviously did this week with the sell-off, are they going to run out of money?
This brings us to the second major pillar of this analysis, and honestly, if I were an investor holding this stock, this is what would let me sleep at night. We call it the fortress balance sheet.
I love that term. It implies you can take a hit. It sounds defensive.
It implies you can take a nuclear strike and keep operating. The report reveals their pro forma cash position is approximately $3.5 billion.
Wait, hold on. Billion with a B.
$3.5 billion.
That is a staggering amount of cash for a company that just hit $40 million in revenue. That ratio seems excessive. I mean, what do you even do with that much money?
It is massive, and a good chunk of that came from a recent equity offering where they raised $2 billion.
Okay, so to be clear for you listening, that means they sold more stock to raise cash, which usually dilutes existing shareholders, right? So that explains some of the stock price. People generally don't like dilution because their slice of the pie gets smaller.
Correct. It's a bitter pill to swallow in the short term. It feels like a penalty. But they took advantage of their high stock price to fill the war chest. And to understand why that specific number $3.5 billion is so critical, we have to talk about the concept of the quantum winter.
The quantum winter. It sounds like a bad sci-fi movie sequel.
Or something from Game of Thrones. Winter is coming.
Right. What does that mean in this financial context?
It's a theory that's been floating around the deep tech industry for a while. The idea is that as interest rates stay high, or as the initial hype around quantum fades, funding for quantum startups is going to dry up.
Easy money disappears.
The faucet turns off. Venture capitalists will stop writing checks for unproven tech because money is expensive now.
And companies that need cash to keep the lights on, but aren't making a profit yet, will effectively freeze to death.
They won't be able to raise more money, they'll run out of runway, and they'll either go bankrupt or get bought out for pennies on the dollar.
So in a quantum winter, cash isn't just nice to have. Cash is warmth. Cash is life.
Exactly. And IONQ has the biggest heater in the room. The analysis argues that while other companies are going to be scrambling for funding, cutting staff, or slowing down research just to survive, IONQ can keep the pedal to the metal.
Okay, so let's contextualize this $3.5 billion. Is that a lot compared to the other guys? Who's their main rival in this space?
Their nearest pure-play competitor, so a publicly traded company that pretty much only does quantum computing, not a giant like Google or IBM, is Rigetti Computing.
And how much cash does Rigetti have in the bank?
About $450 million.
Wow, okay. That is a stark contrast.
So IONQ has roughly 7 times the cash runway of its closest competitor.
That's not even a fair fight. That's like showing up to a knife fight with a tank.
It really changes the strategic landscape. Think about what that money allows IONQ to do. It's not just about keeping the lights on. It gives them optionality.
Like what? What do you actually do with $3.5 billion in an industry that's still building its first real products?
Well, first, you don't have to panic. You have a safety net of probably 6 or 7 years at their current burn rate.
That's an eternity in tech.
It is. Most startups are fighting for 18 months of runway. But more aggressively, it allows for consolidation.
Meaning they can buy people.
Exactly. If a smaller competitor has a really great piece of technology, maybe a specific patent on error correction or a brilliant team of scientists, but they're running out of money because of this quantum winter, IONQ doesn't have to compete with them. They can just buy them.
They can go shopping.
They can acquire struggling competitors without even taking on debt. They can just write a check. They can consolidate the industry under their own banner.
Absorb the best talent and the best IP. That is a powerful position to be in.
You control your own destiny.
But, and here's where I have to pull us back to reality. If they have all this money and they're making all this revenue, why did the stock drop 14%?
Right.
We can't ignore the market reaction. We have to address the elephant in the room.
We do, and this is where we have to look at the bear case. Why did people sell? Why is there fear?
Because if everything is so perfect, people wouldn't be dumping the stock. There has to be a catch.
There's a scary number in the report. And if you are a traditional investor used to looking at profitable, steady companies like, I don't know, Coca-Cola or Apple, this number looks absolutely terrifying.
Not me.
The operating cash flow was negative $123 million.
Ouch. Okay, let me do the math here. They brought in $40 million in revenue, but they burned $123 million.
Correct.
That sounds bad. I mean, the sentiment I've seen online is basically they are spending $3 just to make $1.
Yep.
How is that a sustainable business model? Isn't that how you go broke?
If this were a grocery store or a car dealership or even a software company, it would be a disaster. You'd be out of business in a year. But we have to remind you, this is deep tech. The economics are completely different.
Help us understand that difference. Why is burning $123 million a quarter acceptable here? What are they spending that money on?
They're spending it on hard R&D. You see, in deep tech, you aren't fighting for a 5% market share of an existing pie. You are fighting to bake a pie that has never existed before. You are trying to build a monopoly.
Right.
You are building quantum computers that can solve problems today's supercomputers couldn't touch in a billion years. The barrier to entry is the cost.
It's massive.
It is. You have to build the fabrication plants. You have to hire the Nobel Prize-winning physicists, who are very expensive. You have to develop the software stack from scratch. You're literally building the future physics of computing.
So it's an upfront cost game.
It's a winner-takes-all game. The counter-argument to the bear case is that this burn rate isn't a distress signal. It is a calculated, aggressive expansion. With $3.5 billion in the bank, $120 million quarterly burn is affordable.
So they're just spending that money to widen the gap between them and everyone else.
Exactly. They're buying speed. Every dollar they spend on R&D today is a brick in the wall that keeps competitors out tomorrow. If they tried to save money and only spent, say, $20 million a quarter, they might get overtaken. They are using their cash advantage to ensure they win the race.
That makes sense. It's like building a railroad in the 1800s. You have to spend billions laying the track across the country before you can charge anyone for a single ticket.
This is a perfect analogy.
But once the track is down, you own the route.
That's it. And right now, the market, the people selling the stock, is looking at the cost of the steel for the tracks and panicking. They're ignoring the fact that IONQ is the only one building a transcontinental line that's actually carrying freight.
There is also a point in the analysis about valuation compression. Can you explain that? It sounds like fancy finance speak.
It's a bit technical, but it's crucial. It basically refers to the price-to-sales ratio, or PS. It's a way of measuring how expensive a stock is relative to how much money the company brings in.
Like how many dollars you pay for the stock for every dollar of revenue they generate.
Exactly. Even after the drop to $30, IONQ is trading at something like 50 to 70 times its sales.
Which is high.
It's very high. For context, a normal tech stock might be 10 or 20 times. A car company might be 1 time. So IONQ is priced for perfection.
Okay.
When the market gets jittery, investors look at that 70 times multiple and say, that's too rich for my blood. They sell to lower that multiple.
So the expert take here is that the market is just correcting the multiple. They aren't saying the business is bad.
Yeah.
They're just saying the price tag was a little too high for the current mood.
Exactly. It's a pricing adjustment, not a judgment on the quality of the technology or the business execution. The business is executing flawlessly. The stock price is just catching its breath after running a marathon.
So we've covered a lot of ground. We've seen the explosive growth, the 221% revenue jump that is absolutely no joke. We've looked at the massive cash pile, $3.5 billion. And we've looked at the scary burn rate and why it might actually be a strategic weapon. What is the final verdict from the analysis report? What does the report conclude?
The report is unequivocal. The rating is strong buy or aggressive accumulate.
Aggressive accumulate. I like the sound of that. It has urgency. It's not just buy. It's buy as much as you can.
The analyst view is that despite this volatility, the long-term targets remain valid. They are still looking at price targets in the $90 to $100 range based on the revenue curve for 2026 and 2027.
So if its stock is at $30 today and the target is 90, that's a 3x potential upside.
Roughly, yes. The conclusion of the report is that this drop to $30 and change is a gift. It's a second chance for anyone who missed the boat when the stock was cheaper.
No.
You're getting a company that is growing at 221%, has a fortress balance sheet that guarantees its survival, and you're getting it at a discount because the market got scared of a shadow.
So going back to the title of our deep dive, the joke is on anyone who is selling right now.
That's the sentiment. If you sell now, you are reacting to the noise and missing the signal. You're selling the railroad just because the steel bill came in right before the trains start running.
That is a compelling picture. It really reframes the whole situation. Instead of seeing a red arrow and panicking, you see a clearance sale on a future giant.
And that's the value of digging into the sources. Headlines are designed to scare you. Data is designed to inform you.
I love that. Headlines scare, data informs. That sums it up perfectly.
And the data here says IONQ is stronger than it has ever been. It feels like the risk profile has fundamentally shifted.
Oh, so?
It used to be, will this tech work? And will they go broke?
Right.
And now, thanks to the revenue growth and the cash balance, the answer to will they go broke is almost certainly no. So the risk has shifted from will they survive to how big will they get?
That is a much better problem to have.
It's the right question to ask.
Before we sign off, I want to leave our listeners with something to think about. Bit of a provocation. You mentioned this idea of the quantum winter and IONQ being able to buy up competitors with that massive cash pile.
Right. The consolidation play?
If that happens, if IONQ uses that $3.5 billion to survive the next 7 years while everyone else freezes or gets bought out, are we even looking at a competitive market anymore?
That is the fascinating endgame scenario.
If they're the last one standing, or the one that swallows up the best tech from everyone else.
Then we aren't witnessing a race. We are witnessing the formation of a natural monopoly.
Exactly. Yeah. And if IONQ becomes the Standard Oil or the Google of quantum computing because they were the only ones with the cash to survive the winter, does the stock price at $30 or $40 even matter?
If they achieve true dominance, no, we're talking about a valuation that could be completely decoupled from what we see today. We're talking about owning the infrastructure of the next century.
That is a wild thought to end on. Are we watching a monopoly being born in real time, disguised as a volatile tech stock?
It's certainly a possibility that the numbers support.
Well, there you have it. The numbers, the context, and the big what if. Thanks for helping us unpack all of this.
My pleasure. It's always fun to look under the hood.
And thank you for listening.
Don't forget to like, share, and subscribe for more.